G'day everyone, welcome back to Pete's Investing. I've been off for a few weeks, and yes, I've had COVID about 3 or 4 weeks ago, about 100% better today. Just a mild sore throat and a bit of lethargy, but otherwise I'm okay. Anyway, enough about me. Today we're talking about the CCI14 trading strategy, which was done a few videos ago. We're going to expand on that and show you as well as the long entry, which was covered in the previous videos. I'm going to be covering the short strategy as well, and how to make money out of that with the average down approach. As always, don't forget to hit the subscribe button, the notification bell, and like the videos, and refer to our playlists. And in the playlist you can see there we've got our indices, the share price reviews, and the strategy reviews. And in the strategy videos you can see there the average down process, simple trading strategy, and some money management ideas. Again, we're not offering financial advice, it's purely an educational video series. So let's get started. So what we're going to cover today is the CCI14 entry strategy, as well as looking at the exit, because a lot of videos you might notice out there, they show you how to get into a trade, but they don't necessarily tell you how to get out. So we're going to be showing the exit strategy on that. The average down strategy, and what that means is we don't use stop losses in our approach. We average down until we get out of the trade with some profits. So we try not to lose any money. In fact, the strategy doesn't lose money as long as you pick good instruments to trade. And what we do, we've back tested on a group of select stocks on a daily time frame. This all works on all of these instruments. We look at indices on a 15-minute time frame and the FOREX on a 15-minute time frame as well. We show you some what sort of funds are required in terms of the drawdown when we use the average down approach. So we have to make sure we've got sufficient funds in our account to trade this approach. And lastly, look at the average revenue generated. And these are all estimates, obviously, because every instrument will yield a different result depending on your strategy you use and the time frame. So let's get started. So the long entry rules, and again, these was covered in a few videos ago. We look at the entry is the CCI14 breaking above the zero. Let me go to a the chart, which shows you a practical example. So this is the price chart down here. This is the ASX 200 in CFDs, and we're trading one contract each time we buy. This shows you the number of contracts entered. You can see there positions 1. So we enter one contract there at the price of 74.82. This is the short strategy, and I'll explain that in a few minutes. Now, that's the entry strategy. When the CCI14 breaks above zero, we enter the trade if you haven't already opened up a trade. We let it go, and the exit strategy is when the moving average 20 crosses down. As well, we want to have a minimum gain of the average. I use the average of the last 100 bars of the average range, and that gives me a nice little return. So we don't want to get out with $5 return or a $10 return. We want to get out with a nominal of about probably at least 10 to 15 point return on our trades, at least. So we exit when the moving average 20 crosses down. So what that looks like is, you can see here we entered the trade there when the moving average CCI14 breaks above zero. We're in the trade there, and this is the profitability chart. You can see there the profitability at that point is, and that baseline is 100,000, so we're looking at 1673. That's where we entered the trade. So the price went up, then slightly reduced there, but you can see there the price was about even with our entry price, so we haven't closed the trade. And you can see there the red of the moving average 20 is starting to break down, so it's turned red. So we don't exit the trade there. It hasn't given us enough yield, enough return. So we stay in the trade. The price keeps going up and the moving average keeps going up until it finally starts turning down again. But again, that still wasn't enough return according to my strategy. And again, you can use this at whatever suits you in terms of a return. You can see there that price there on that red bar, the close was 74.81. And our entry there was 74.82, so it's still not breaking above our profitability level. So we stay in a trade, it's gone down, the price goes down, and then the price accelerates, goes up, until we finally exit the trade when the moving average 20 breaks down again there. You can see there, it breaks down at 75.25, the price of the chart. We opened up at 74.82. So that's where it closed out that little entry there and exit there. You can see there the profitability started at 16.73 and trading one contract. It closed out at 17.16. So that's in Australian dollars. So it made a nice little return on that over this is a 15-minute chart over those over that day and a half. So you can see there that's a day time frame, and these are all hourly time frames. So that's our single entry and exit of a trade. You can see here as well the average down approach on the long entry. I'll show you that now. And I'll show you on this little example here. Each of these blocks you can see here enters one contract and closes out one contract. Enters one, closes out one. In this example, you can see here it enters one contract. The price went against us and it enters another contract there. So now we've got two contracts. So positions 2. So if we drill down on that as an example, we entered a trade there, price at 75.30, we entered one contract. Okay. The price went about sideways, then it finally dipped. Now, the dip as well, as part of our trading rules or average down rules, we're saying similar to our exit strategy, we want a loss of our average of the last 100 bars. So the average of the last 100 bars was equivalent to about that range, and it enters another contract there. Now you can make that 10% reduction, 15% reduction, or even a 5% reduction before you enter another contract. I'll leave it up to you, but basically the more contracts you enter, the more funds you'll require in terms of entering these, and I'll explain that funds required in a few minutes. So here we've entered another contract. So now we've got two contracts entered here. The price goes sideways. We're still not in a money-making position. The price starts accelerating until the moving average, and you can see there the moving average starts turning down. It turns red, starts turning down, and we exit. You can see there it's exited one at two contracts at 76.37. So if you look at the closing profitability, it's 2004, and here we started back at 17.16. So it made about almost $300 in revenue in that trade there over those probably, 3 or 4 days. So that's our average down approach for going long. Now the short entry rules are simply the opposite. When the CCI14 breaks below the 0, we enter the trade on a short position. Let me give you an example of what that looks like. Let me drill down on one of these singular trades. Let's look at this one here. So again, this is the short strategy. We're entering 1 or -1, which is going short one position, and that's indicated by that red arrow. So it goes short at 7,200. The price goes in our direction, and it closes out at that point there, because similar to the or opposite to the long position, we enter when the CCI14 breaks below 0, and then we exit when the moving average starts turning up. In this case, it turns blue, it starts turning up. And you can see here all this period there. During that period, it stayed red, which means it was going in our direction in the short position. So you can see there it closed out at 71.41. Now we entered at 7,200. So it made about 60 odd points in the decline of the share price, or the index price in this case. And we entered one and closed out the same one position. So you can see here profitability closed out at 3,609 and opened up at 3,550. So it made about 50 odd point gain in profitability in that little trade. And then lastly, I'll show you the average down process. It's simply, again, opposite to the long approach. We average down when it closes greater than the average price, and the minimum gain is lost in terms of going upwards. So if I show you that, let me find you a simple example, maybe back here. Now in this example, it entered, let's just try to drill down. You can see here it entered one position there. It went short because the CCI 14 broke below 0. it entered one position at 73.52, one position. The price went against us because it was going in an upward direction, which is not what we want when we're going short. We entered another position here at 74.37. You can see there it's gained a nice sufficient amount, and then let's say about 10 to 15% gain to keep it simple. And again, I'm using the average of the last 100 bars, but in practical terms, it calculates out to about a gain of about 10 to 15%. So you've made that gain, and we enter another lot there. So now we've got two contracts going short. You can see their positions -2. The price kept going up, and we entered a third position short there. Now we've got three positions. The price starts declining until we reach our profitability level, and we close out those three positions at 73.82, and we had a position open at 74.64, 74.37, and 73.52. So you can see there, although we entered there on that one position, that would have been our break even down there. After we entered the second position, our break even would have been about halfway. Third position, our break even would have been around about a bit higher than halfway. So you can see there profitability closed out at 19.50. We opened up profitability at 18.42. So I made over $100 in gain in that period, in those between the start of November until near the 12th of November. So about 12 days, and made a nice little return on that short position. So what it looks like over the period, over the 15-minute time frame, you can see here all these steps are multiple entries made. There's a few single entries made there, but these ones are all multiple entries. That's a big one at the moment, and that's still live. So that trade is still going. We're 22 contracts into that position there. In the short position, you can see there we had a maximum of, a hover over that, 18 positions short, maximum. You entered there, but you can see there when it closed out, profitability there was 18.42. And we started back here, profitability at 5.08. So it's made over $1,200 in that trade there. To give you a summary of the results for the ASX, but also for the other trade, this is the long positions. And again, I was trading on the CFDs, the ASX 200, which I just showed you the example. And we went a maximum, and this is the trading criteria, by the way. I just maximized it in the previous chart. This here shows you the number of the maximum number of contracts entered during the period. So the ASX 200, just using that as an example, the profitability was 31.06 when I drew this chart, when I drew that table. Now it's gone up quite a bit since then. Profitability currently is 41.95. Okay, and that's still live. That's still trading, that trade. You can see there, number of contracts, 22. And that is the number of contracts. Each contract on the CFDs, and this depends on your broker as well, each contract costs $369 at the time of this video. So I'm entering 22 contracts at the max. So over that period, that was the biggest number of contracts entered. In other words, you don't need 22 during the whole period. And that equates to $8,118 for 22 contracts. The maximum drawdown is simply the highest profitability down to the lowest profitability. So for the ASX 200, $12.98. And we're simply looking at highest profitability, about there, down to about there. That was $1,298 in terms of lost, or the drawdown required. It's not actually lost revenue, it's just a drawdown of that you need funds in your account. So again, our baseline for funds is $100,000 for the longs and $100,000 for the shorts. So in summary, what that looks like is profitability. We used 22 contracts at the maximum level. So we needed $8,000 just for the number of contracts. The drawdown was $12.98. So we needed drawdown on contracts, about $9,500 in our account to get the trade alive. And since the start of September 21, it's 155 days calculated. If today's date is the 9th of February, it works out to about $20 per day, just simply that divided by 155. I won't go through all these other ones, but just the same sort of example as the ASX. So basically you can see here for the short criteria, the max number of contracts required was 18. And looking at the short example, it generated $3,500 over the period since the start of September, and the maximum was 18 contracts. So again, we need $369 odd per contract, which equates to 6,642, and the maximum drawdown was 2368. So again, the drawdown was the maximum point of profitability down to the lowest point of profitability. It could have been that point to that point, or it could have been from that point to that point. Again, it's just telling you what sort of funds you need in your account to keep the trade alive. So as you can see, that generated $23 per day in trades. If you look at 3,500 divided by 155 days. You can see there the price has dropped somewhat because the price is accelerating here on the going up on the longs. Therefore, the profitability on the shorts is dropping. Now, one thing you'll notice as well is when a short's going in negative direction, like in this case, the profitability is dropping. You'll see here the price is accelerating, going up, which means you're going to be generating small returns and somewhat small multiple contracts in this example. When the price goes in our favor for shorts, in other words, it's going down, you can see here there's small contracts being entered, and that's where we start entering more contracts in the long positions. Again, you can see here the price is going down, more contracts being entered in the long, and only few contracts being entered in the shorts. So it basically balances itself out. But over the period, you can see there 3,300 at the moment. It's a live chart, and 4,200 on the longs, and that's demonstrated by the chart I'm showing you here. 2,300 as when I was first drafted this slide. 2,300 for the shorts, and 1,200 for the longs. Now I did the same for all these other indices, the US market, the German market, the FTSE, China market, and gold. Now, one thing to keep in mind is you don't have to trade all of these, obviously. You can pick and choose one or two or more of these that you feel comfortable with. Just be mindful, some of these require quite hefty margins. You can see here the China market requires 1,566 per contract. So if you're entering in 20 contracts, you're going to need $31,000 in your account to keep it alive. So, and the drawdown was 8,200. Whereas gold, it needs $89 per contract. So for 22 contracts, for 89 each, you need 1,958 to keep that alive and keep it trading. That's basically the long and the short of it. It's the short strategy we spoke about and the profitability. So it works out about $550 per day on the short and $188 on the longs. Now don't forget, over the period we've been looking at the moment, the market has been going sideways at best and downwards during this period since October, November last year. So the market's been going flat. If the market was appreciating and going north, you would have had a higher return on the longs. The longs would have been more profitable, and the shorts would have been less profitable. So it basically balances itself out. But overall, as you can see there from the chart, at any one of these points, you're making good money on both long and short. So again, that's it for the long and short strategy using the CCI14. Don't forget to hit the subscribe button, the notification bell, and like the video. And don't forget to refer to the playlists and refer to the trading strategies in those playlists. Thanks, and I'll see you next video.